Good day and welcome to Crypto Chronicles, the go-to channel for the latest news and insights on cryptocurrency and related topics. Today, we'll be delving into futures trading, a widely used strategy among traders for buying or selling assets, including commodities and cryptocurrencies, at predetermined prices and times in the future.
Disclaimer. The content on this YouTube channel is for educational purposes only and is not financial advice. Cryptocurrency, NFTs, and blockchain investments carry risks. Do thorough research and consult professionals before making any investment decisions. The creators of this channel are not liable for any losses incurred. Viewers should exercise caution and take personal responsibility for their investments.
What is futures trading? Futures trading is a contractual agreement between a buyer and a seller to buy or sell an underlying asset, such as Bitcoin or Ethereum, at a future date and at a predetermined price. This type of trading allows traders to hedge against price movements and manage risks, as well as speculate on future price movements. How does futures trading work? In futures trading, buyers and sellers enter into a standardized contract that specifies the quantity and quality of the underlying asset, the settlement date, and the price. The buyer is obligated to purchase the asset at the agreed-upon price at the settlement date, while the seller is obligated to deliver the asset at the settlement date. Key concepts and terminology. There are several key concepts and terms that are important to understand when it comes to futures trading. These include margin, leverage, and settlement. Margin is the amount of money that traders are required to deposit to open a futures position. It acts as collateral to cover potential losses. Leverage allows traders to control a larger position with a smaller initial investment. This increases the potential for profit, but also the potential for loss. Settlement is the process by which a futures contract is settled. There are two types of settlement: physical and cash settlement. Physical settlement requires the delivery of the underlying asset, while cash settlement involves the payment of the difference between the contract price and the market price. That concludes our discussion on futures trading. We hope that you found this video informative and helpful. Don't forget to subscribe to our channel for more updates on cryptocurrency and related topics. Thanks for watching Crypto Chronicles.